Hi guys, this is a recording of my weekly video. Just wanted to revisit the offer process with everybody. Obviously, we're now seeing quite a lot of offers being made, and that's obviously really encouraging. But just really wanted to reiterate the importance of the presentation that we like to present to a business owner when we're making an offer. I think this is our real opportunity to convince them not just of the financial components of the deal, which I think a lot of people feel is probably more of the important part of the offer presentation, but actually in equal measure, it's also selling us as a buyer in that we're going to build upon what they've created, not fire the staff, grow the business, invest in it, etc., etc. And that for me is equally important in my experience as the financial component. So if you like, this is our 30 to 40 minute pitch to convince the business owner that this is something that they really need to give strong consideration to. So yeah, we have a number of slides to share. These are really something you can share on Zoom and use as really a prompt to go through. But effectively, this is a live example of a business that we've offered on. I've obviously taken off the name of the company to protect confidentiality, but I'm just going to run through how I would present this to the business owner. So today we would like to make a proposal for us to acquire ABC company. So what we're going to cover in this call today is what our proposal looks like, what our experience and expertise are, both in this sector and generally. We'll walk you through the process that we're going to follow if we get this tied up. So what happens pre-completion, what happens once we own the business, what does that handover and succession planning look like, what are the sort of timescales to be considered. We're also going to look at the sort of legal and deal structure, what our focus is going to be, of course, the financial components of the proposal, and the real estate element of the transaction. We'd only mention real estate here if there was something specific about it. So in this particular example, the business owner owns the premises, so we're just going to mention that we're going to lease back the premises on the same commercial terms that are already in place. Obviously, if it wasn't really relevant, then we'd of course remove that. So our expertise at Opulentia is that we've done over 90 transactions over the last 12 years across 26 different industries, 9 different countries, and then we've been involved in the construction and glazing industry already. We're currently owners of Millbridge Construction, which is based in London, which is a high-end residential development company. We're involved specifically in the glazing industry in that we acquired Colville Glass Glazing last year, which basically supplies UPVC windows and doors into the new home sector, and also has a retail arm. And we have ASM, which is based in Australia, which is a fabricator, so they make the window frames. Clearly, I only mention that if we actually had specific industry experience, or I would try and draw upon an industry where there's maybe a crossover. Obviously, if that's not applicable, then we wouldn't mention that. These are the people that are involved in trying to make this happen. So firstly, we have the team at Opulentia. There's myself, there's my colleague Matthew and Goran, who you've met as part of the process. And then there's the operational team that are the conduit between Opulentia and our day-to-day operational team that will run the business. So Simon Martin's our CFO, Peter Lawrence is our Group People Director, Ben Seabridge is our non-executive director that represents us as investors in this particular business. We collectively have over 100 years experience. Simon trained in Big Four accounting. He spent many years as FD in SMEs as well as large corporate. Peter's been at corporate level in HR for almost 30 years. So that gives you an idea of the people behind Opulentia. So in terms of the process that we're going to follow, assuming that we agree a proposal, then we would agree a term sheet. And for me, a term sheet is really what I call the roadmap. So it's a 4-page document that basically spells out the deal that we're trying to do, the purchase price, the process, the key conditions, and we hand that over to the lawyers to draw up the relevant legal paperwork. Once we've done that, we'll run through due diligence. So there's 3 sides to this. There's the legal due diligence, the commercial due diligence, and the financial due diligence. Legal is for us to investigate any material contracts within the business, the legal constitution of the company. Commercial, which we've already done a degree of, is understanding the business model, the revenue model, who your customer base are, how you fit into the market, what the wider market is doing. And financial is looking at what's behind the numbers within the financial statements and understanding assets, liabilities, profitability. Once we've done that, we'll be able to then produce a fairly detailed financial model. Usually this is a 5-year cash flow, profit and loss and balance sheet model, where we basically take various assumptions and scenarios and sort of do a best case, worst case, somewhere in the middle case, which then gives us confidence that obviously the way that we're structuring this deal is more than viable and affordable. Whilst that's happening, we're also concurrently working on the legals. So we have an in-house legal team and an external lawyer that will produce the contracts. The main one is the sale and purchase agreement, which covers the key terms and conditions. There's also then some ancillary paperwork that accompanies that. Funding, again, whilst we're doing all of the modelling and the legals and due diligence, we're also raising the funding. So we work with specific asset-based lenders, and when we come onto the deal structure, we'll talk more specifically about the funding. And once all of those things are lined up, we then get to a completion. Timescale is very much dependent on you, Mr. Business Owner. It depends on how quickly you provide us with information. Typically, the due diligence process takes 4 to 6 weeks from once you provide us with all the information for us to sort of review that, come back with questions and queries. Financial modelling usually takes a couple of weeks of us obtaining various data. Legals, whilst the contracts can be put together relatively quickly, there can be quite a lot of discussions and negotiations around key terms, which we always refer back to the term sheet in terms of what the core components are, so that we can get to an agreement. So typically working through all of that process, best case probably looks like 10 to 12 weeks. Worst case, if we're going to be proactive with it, maybe 16 weeks. So that's relatively straightforward and very similar to a house sale or purchase, but that's a typical process and timescale that we look at. In terms of the process, pre-completion, we'll work with you on a communications plan. So the key people that we want to communicate with first off, so probably the day of or day after completion, is we'll meet as many of the staff as we possibly can. And it's really a message of reassurance. Nobody's going to lose their jobs. No one's getting fired. It's business as usual. The same management are still involved in the day-to-day runnings of the business. Then we'll move on to the key stakeholders. So this will be customers, suppliers, funders, landlords. And usually it takes a couple of weeks to sort of work through all of the key people to provide the same message of reassurance. So that sort of starts on day one. First 30 days really are about us understanding how the business operates, having those communications. And then we work with you over a handover period of 6 to 12 months, which is really for us to try and understand how you run the business, the role that you play. We want to protect the goodwill. So one of the risks from our point of view as a buyer is that on completion, customers could go elsewhere, suppliers will get a bit jittery, same with landlords, key staff may leave, and obviously we don't want any of those things. So we work with you to try and build those relationships over that 6 to 12 month period. If you're looking to leave, then obviously we need a succession plan. So at this point of the conversation, I'd relate it back and be more specific to them. So if they've already told us there's someone in place to take over from them, then I'll be talking about that. If there isn't, then we'll be talking about them being involved in helping us recruit that individual. And one of the things that they might want to look at is the testimonials on our own website of sellers that have been through this process, joint venture partners and staff of businesses that we are either involved in or have been involved in. So you can hear from real people that have been through this process and what it's like to work with us. In terms of the legal structure, we use an SPV, that stands for Special Purpose Vehicle. This is a limited liability entity. Effectively, that will be owned by Opulentia, its shareholders and partners. And the SPV will act as a holding company for the target business, and it will own all of the shares. This keeps a nice, clean, easy to understand structure and keeps all of our assets and other businesses separate. So basically everything's in one place until such point as any debt and stuff is satisfied. Our focus once we become new owners will be very much about protecting the staff within the companies. So really it's about giving them more tools, more resources, more capital to grow the business. That will give them greater opportunities, particularly if we're looking to build a larger group, particularly from a career perspective. We're not going to change the name. Spent many years building up the brand name and the reputation of the company. So for us, that's an asset to have, and why would we want to change that? We would be looking to provide more opportunity through the group build out by making strategic and tactical acquisitions of related businesses. As I mentioned before, you can look on our website for specific testimonials. Feel free to have a look at them. And also wanted to just give you a bit of background about our founder. So obviously, if I wasn't presenting this isn't how I would say this, but if I was presenting it, I'd say it slightly differently. But our founder, Paul Seabridge, is the #1 best-selling author on Amazon. His recent book, Buy, Build, Sell, if you have a read of that, will give you a bit of a flavour for our approach to business, some of the businesses we've been involved in and what we've done with them, and what happened. So in terms of getting into the deal structure, so it's not uncommon for us to experience, when we look at your balance sheet, there's clearly a lot of surplus cash on the balance sheet. I guess as a business owner, you take out dividends and what you need to support your lifestyle, but if you're making more profit than you need to support, then you're probably going to leave that there, because it doesn't make financial sense to withdraw all of that cash, because you'll be clobbered with dividend tax. So over the years, it's not uncommon to see a lot of surplus cash. We're going to include that in the sale because it's more tax efficient to pay that out on completion. So if you benefit from entrepreneurs relief, which you probably do, it's now called business asset disposal relief. On the first $1 million, less your personal allowance, you can withdraw cash at 10%, pay capital gains tax at 10%, and then anything over and above the $1 million is then taxed at 20% versus dividend tax of between 30 and 40%. So quite a significant saving. We'll then inject new debt into the balance sheet. So effectively, we borrow against the company. That debt is affordable and viable, and all of that is then used to facilitate the payment of the initial consideration, with the balance being on a deferred basis. Since the financial crash of 2009, 2010, banks have been very limiting in terms of them funding acquisitions like this. I guess the reason for that is in the SME space, it's very high risk. Whereas in large corporate, they tend to have a much more diverse income stream, maybe diverse products and services, different territories, geographies that they trade from, and that makes them less of a risk. 95% of business startups fail in the first 5 years in the UK, and only 1% of them make it to £1 million of revenue. So the chances of success are quite slim, and I guess that's the reason why banks are less willing to lend. So generally, lending is supported by assets. So we will be looking to fund against the assets within the company, and then we ask the seller to take the position of the bank because the banks won't lend. So effectively, you become the bank, and we pay you on a deferred basis for the balance. There's then an earn-out structure. So to give you a top up on the overall purchase price, we will be sharing a percentage of the uplifts of profits, and we'll get into the details of that. We've based this deal on the most recent management information that we've received. So we've taken an average of the profits over the last few years. We've looked at the balance sheet, so what assets and liabilities will acquire on completion, and we add that to the goodwill valuation. But on completion, the balance sheet might look different. It could be worse, it could be better. More likely it's going to be better. So we have a mechanism within the deal to be able to work out the difference between what the balance sheet that we've used in the calculations are and what the completion accounts actually are. And then we would add the difference to the deferred consideration. So in terms of the specifics for your company, we've looked at EBITDA, so earnings before interest, tax, depreciation, amortization. We've looked at the last 3 years, and we can see that there's an average profit there of 552K. We've already added back directors' remuneration and pension, as well as wage subsidies, because these are non-recurring items. So effectively, once we acquire the business, we'll benefit from that because we won't be paying the same pension contributions. Those wage subsidies won't exist. And the director's remuneration will stop after your exit. So we've added those back to the calculation. And with the balance sheet, it's fairly straightforward. The only adjustment that we're making here is that we can see that there's an outstanding director's loan account, so we're going to gross that up into the consideration. So our financial proposal will be overall purchase price of 3.652 million plus the earn-out consideration. So the initial consideration will be 1.383 million. The deferred consideration will be 2.54, which will be payable over 4 years in instalments. And the earn-out consideration will be calculated at 20% of the profits generated from supplying Coalville Glazing Company. This represents a 6.64 times multiple of EBITDA, which is above the average for businesses trading in this particular industry. In terms of the real estate, you own the real estate, so we're going to enter into a commercial lease on similar terms to be agreed. So that's really our proposal. It's over to you now, Mr. Business Owner, for any questions or next steps. So that's how we would present an offer to a business owner. It's fairly self-explanatory. We spent more time selling us as a buyer than actually on the financial proposal. And we've explained, obviously, the reasons why we've structured it the way that we have, and obviously how we've come up with those numbers. So there's a bit of logic behind it.